Welcome to Talk Tickers. Today, we're diving deep into the Q1 fiscal 2026 earnings for the global consulting and engineering firm Tetra Tech. That's ticker TTEK.
All right, here's what we've got on tap. We're going to look at the headline numbers, then figure out what was really driving them. After that, we'll talk about the outlook and a pretty big risk on the horizon. And we'll wrap it all up with an actionable trade idea. Okay, let's get into it.
So, let's set the stage. Tetra Tech dropped their numbers after the bell on January 28th. The conference call was the next morning, which gave the market plenty of time to really chew on what turned out to be a very, very strong report.
And you know what? The market absolutely liked what it saw. This was a classic beat and raise quarter, and the stock popped on the news. Let's break down exactly how strong these numbers were.
First up, the bottom line. Adjusted earnings per share came in at 35 cents. The street was looking for 31 cents, so that's a beat of almost 13%. A really solid start.
But here is the real stunner. Revenue. They clocked in at $1.21 billion. Now, the estimate was $974 million. That isn't just a beat, my friends. That is an absolute blowout, crushing the consensus by more than 24%. Just a huge number.
So what was the result of all this good news? Well, the stock jumped over 3% on the day of the call, and look at that volume, more than double the average. That tells you institutional money was piling in. The street gave this a big thumbs up.
Okay, so we know they beat expectations, but the really critical question is why? What was under the hood here? Well, this quarter was all about quality and execution. It's a fantastic story.
Now this is where things get really interesting. Forget the headline revenue for a second and look at that last line. Adjusted EBITDA margin expanded by 140 basis points. That is a massive move. It tells you this wasn't just about selling more. It was about being way more profitable. The quality of their earnings improved significantly.
And this right here, this is management's playbook in action. They're deliberately shifting to higher margin work, like early stage consulting. They're trimming the fat, selling off their Norway business. And they're making really smart, targeted acquisitions in the defense space, which, by the way, is a great place to be for stable government contracts. On top of all that, they're funneling cash back to shareholders with a nice dividend hike and $50 million in buybacks. This is a team that knows exactly what it's doing.
All right, let's pivot to the outlook. Because for all the great things that happened in the quarter, management was also very clear about one major storm cloud on the horizon.
And this slide really sums up the whole debate for an investor right now. On the left, the bull case. Management is so confident they raised their full-year guidance for both revenue and earnings. Fantastic. But on the right, the bear case. They're explicitly warning about the chaos in Washington, D.C., pointing to shutdown risks and policy shifts that could hurt their business. And the CEO, Dan Batrack, was incredibly upfront about this on the call. He didn't mince words. He's basically saying, look, we're executing at a high level, but we're operating in this really challenging political environment that's totally out of our control. This isn't just some minor risk. They see it as a central issue.
So that brings us to the big question. You've got this great company firing on all cylinders, but it's clouded by this huge macro risk. How in the world do you trade the stock from here?
Let's think through a smart way to position yourself for the next quarter.
So here's our official take. We're initiating coverage with a market perform reading. And what that really means is we think the company's strong performance is already baked into the stock price. And all this uncertainty coming out of DC is probably going to put a lid on how high it can go in the short term. So for those of you who've enjoyed the ride up and want to protect those gains, we're suggesting a strategy we're calling the DC collar. The thesis is simple. The good news is priced in, but this Washington risk is not. So what do? You can sell a call option, which caps your upside. And you use the cash from that sale to buy a put option, which acts like insurance on the downside. The goal is to create a low-cost or even zero-cost hedge against that political risk without having to sell your shares.
This is not financial advice.